Hi folks, welcome to this video. We'll use the data here that we're given for the company called GIA, and what we're supposed to do is we have to prepare a statement of cash flow, a statement of financial position, which is our balance sheet, and we have to perform some financial analysis. So let's have a look at the problem. The problem says that the company GIA had the following statement of financial position or balance sheet at the end of operations for 2010, and GIA applies ASPE, or Accounting Standards for Private Enterprise Standards. So now this is going to become relevant as we go through the data in the program, so that's why I've got a little footnote here, or endnote in the problem, and we'll discuss that as we go through the data. So now again, we've got the balance sheet or statement of financial position at the end of 2010, and again we notice that we have a couple of current assets here, cash, AR, and fair value through net income investments. You remember from your one of your prerequisite courses that fair value through net income investments are valued at the end of every period at their market value. So any gains and loss on sale are realized into net income, and we may have unrealized or holding gains and losses if we're just revaluing them to market but still holding them on our books. And they are current assets because the purpose when we buy them is to turn them over on a regular basis within the current operating cycle or at the end of the current year, whichever is most suitable. We also have plant assets here, which are at net, so that means net of accumulated depreciation, and we also have land. These last two are non-current, and we have total assets of $194,200. We see we have accounts payable, a long-term note, and equity in terms of common shares and retained earnings, adding up to $194,200, which is the same as our assets. So we know we start from a balanced position as we go into the next year, 2011, and what happened? We know that GIA sold part of its investment portfolio for $19,000, so clearly we know that this portfolio now is no longer sitting at $32,000. We know we sold part of it for $19,000, and it resulted in a gain of $3,400. So we're going to have to use this data that we have here to calculate the new value for our fair value through net income investments. We also had a tract of land that we purchased for $18,000, so we know our land account balance is going to go up by at least $18,000. We also know that we had long-term notes payable of $17,000 that were retired, so that means this number, $41,000, because we retired $17,000 of them during the year, this number should, as a result of that transaction, go down by $17,000. Right? We know we also issued $26,000 more in common shares in the following year, so we know the common share balance will have gone up from $100,000 by at least $26,000, right? We also have dividends that were declared and paid in 2011, so we know that will affect our retained earnings balance. We also have income for 2011 of $32,000, which will also affect retained earnings. But notice the wording here. It says 2011 income was $32,000 after allowing for depreciation of $12,000. So that means that our net income of $32,000 also includes $12,000 because it says after allowing for depreciation. So that depreciation of $12,000 is included in the $32,000. It might have been worded differently. It might have said it does not include depreciation of $12,000, but it says after allowing for it, which means that whatever income we have here of $32,000, it includes in the operating expenses $12,000 of depreciation expense. We have land that we bought, and we issued $30,000 in bonds. So we know again we bought land here of $18,000. We also bought some more land, $30,000. So again we know our land balance is going to go up from $40,000 by 18 over here, plus another 30, right? So this is a non-cash transaction. We bought land and we're going to credit bonds for that purchase. So we debit land and we credit bonds. It was a non-cash investing activity, right? And here, we've got here at December 31st, 2011, there was cash of $41,000. That's our ending balance. We also had accounts receivable of $41,600, and we had accounts payable, which, after all is said and done, remained at $30,000, which is what it was over here. All right, so now they want you to do a cash flow statement, a balance sheet or statement of financial position at the end of 2011, and they also want you to calculate free cash flow, current cash debt coverage ratio, and cash debt coverage ratio. So again, we're looking at more of the solvency area of the company. So now, with all this data in mind, before we begin, I just want to now let you know what the significance of telling you that GIA follows ASPE really meant. Because when you have ASPE standards, it tells you that when you have a dividend that was paid during the year, what that means from a cash flow perspective is under ASPE standards, they must account for dividends paid as a financing activity when they're doing the cash flow statement. If the question said IFRS standards are applied, under IFRS standards, they have a choice as to how they handle dividends paid during the year. They may record it on the statement of cash flow as a financing activity, but the other option they have here that I'm mentioning to you in the little footnote is that they can also handle it as an operating activity. So in the notes to the statements or the notes to the cash flow statement, they have to specifically tell you if they follow IFRS standards, if they're handling cash dividends that they pay as an operating or a financing activity, if they're following IFRS standards. If it's under ASPE, then they must be using dividends paid, cash dividends paid as a financing activity. So whether they follow ASPE or IFRS in these questions matters when you have to do a cash flow statement. Okay, so that's why we mentioned it to you here. So with the data in mind, let's begin. And what I'm going to do here is I'm not going to do things specifically in the order that they've given it to you. I'm going to start with the second part first, and I'm going to do the cash flow or the statement of financial position first. So let's begin that discussion. So now, you might be able to follow this a little bit better. So now let's begin. Now, again, it's probably a good idea if you have the problem and or the solution with you as you're following the video, because that way you might be able to make some notes on it if you want. So if you think if you're the kind of person who likes to take some notes while we're going through the video so you know why the answer is as it is, you might want to print the question with the solution so that you can make some notes. If you want to solve the problem with me and do your own balance sheet or statement of financial position, then certainly, you might just want to print the question. That's up to you. All right. So now we were told in the question, if you'll recall, that the ending balance for cash was $41,000 and accounts receivable was $41,600 and accounts payable was going to be $30,000. So that's why when we're doing the balance sheet, we've got those numbers in there as we see them here. So there really wasn't any calculation for us to do there. Right? Now, if we go into the fair value through net income investments, you recall in the question, they told you that the company GIA had sold part of the portfolio for $19,000, and that transaction resulted in a gain of $3,400. So what we want to do is we want to say, well, we know that we started with $32,000, I believe. If we go back to the question, we had $32,000 in the fair value through net income investment account. So after we make that sale, how much is left is really our question, right? Well, I've calculated it here as $16,400. So how did we get that? Well, I'll just shove this little guy off to the side here, and you'll see what we would do is we would have debited cash for the $19,000. That's what the question told us they got when they sold the investment. We know they recorded a gain of $3,400. The question told you that, right? The question told you all that. So we know that if we plug, we know we got rid of an investment that was valued on our books at $15,600. So if we started with $32,000 in 2010, and we know that in 2011 we got rid of $15,600, so the ending balance in the fair value through net income investment has to be $16,400, which is what we have here. So that's how I got that number. All right. So now you'll notice here I have my plant assets at net of $69,000. Why? Because during the year, we know that we would have made an entry to record depreciation of $12,000, right? So if we recorded depreciation of $12,000, what must that have meant? That must have meant that throughout the year, we debited depreciation expense and credited accumulated depreciation for $12,000. Well, when you increase the value of a contra asset account, you're going to reduce the value of the plant asset at net account. And if you go back to the question, plant assets at net were $81,000. So now net means cost less accumulated depreciation gives us $81,000. Well, we just increased our accumulated depreciation by $12,000. So that means now that we have $81,000 less $12,000, which means we're going to have plant assets at net of $69,000. So now that tells us how we get these two numbers on our new statement of financial position or balance sheet. Now let's look at how we got our value for land. Well, again, this was one of the reasons why I like to go through some of the data with you and explain where it's going to kind of fit in and how it's going to affect the account balances as we were kind of analyzing the beginning of the question. Because you know that in your question, they told you that you bought a tract of land for $18,000 cash, and it also said that land was purchased throughout the year by issuing bonds. So we had a cash flow impact here, but a non-cash impact here when we bought land. But in total, we bought two new tracts of land, one for $18,000, one for $30,000. So what does that mean? That means that we debited land twice throughout the year for $48,000 in total. So therefore, if you started with a balance in your land account, which we know from our question was $40,000, all right, and you've increased it by $18,000 and $30,000 throughout the year, that means your ending balance in your land account is going to be $88,000, right? So we're going to put that here. We also know, and I made a note of it here, at this point we can also calculate the bonds payable account because we never had that account in 2010. But we know in addition to our liabilities that we had for accounts payable and long-term notes, I'm just going to stick it in there right now, the bond payable, which is $30,000. And again, we got that from our original question because they told us that in 2011 you had a non-cash investing activity where you issued bonds for $30,000 in exchange for land. Okay, so now if we go back to our question, we've now dealt with item number 3. Now we want to deal with item number 4, which are the long-term notes here. So I've got a number 4 here. You'll remember we started off with long-term notes payable of $41,000, right? But that balance changed. How so? Well, don't forget during the year it said that you retired some of those long-term notes to the tune of $17,000. So if you had $41,000 to start, you know that you retired $17,000 of them by paying $17,000 in cash out to your to pay them back, right? That means you now only have how much left? You now only have $24,000 left, right? So that means you must have debited the long-term notes payable for $17,000 to reduce them, right? And pay out cash of $17,000. So now your ending balance in that account, you started with $41,000, you retired $17,000, so now you have $24,000 left, which is what we have here. So now we've got our total accounts payable, our long-term notes, and our bonds payable. Don't forget, with our common shares, what happened there? Well, we know that during the year, if we look at the equity side, we know that we issued 26,000 more in common shares. Let's go back to the question. The question told you here that you had an additional $26,000 in common shares that were issued. So therefore that means that we must have during 2011 debited cash and credited common shares for $26,000. So if we add that $26,000 to the balance we have in our common share account currently, which is $100,000, that means that we are going to have an additional $26,000 in common shares. So our balance in our balance sheet should be $126,000 in common shares, right? Now, to get retained earnings, we could do it in one of two ways. We already have our total assets of $256,000. We already know that for a balance sheet to balance, we need liabilities and equity to balance to that same number. We could plug it, but not everything in accounting could be a plug. If you have the information that you need, then you should be able to calculate it. And that's what we did. So we have retained earnings here of $46,000. How did we get that? Well, let's use the data. We know that our ending balance in retained earnings at the end of 2010 was $23,200. If you go back to the original question, they gave you that. We also know in our question that our net income for 2011 was $32,000. How do we know? The question told us that as well. It was $32,000. All right. We also know that we had dividends declared, and we know that when we declare dividends, we declare them through retained earnings. And they told you in the question that the dividend declaration was $9,200. So now, if we go back to our question, that must mean that retained earnings at net or increased by $32,000 and decreased by $9,200 when we had our dividends declared. So we know that our retained earnings went from $23,200 to $46,000 if we net out this debit from this credit. All right, so we've got $46,000. So we don't need to plug anything. We can actually calculate it and get $256,000. So this concludes our calculation of all the amounts that we have on the balance sheet for GEA in the following year, 2011.